Hi everyone, welcome to a brand new monthly economic update for the month of January for the year 2025. For the month of January, we start off with an update on the monetary policy side. The central bank maintained the open market or the overnight policy rate at 8%. And as you see here on this particular slide, the reasons given are there's quite a number of reasons. For example, inflation expectations and policy stability, supporting economic growth, and most importantly, balancing credit growth and financial stability and managing the external sector, and also ensuring that there is sufficient buffers to respond to future risks. And what is important is in their fan chart, what they have given as predictions. The central bank believes that by Q3 of 2025, inflation will start picking up, because as of now, headline inflation is at a deflationary level. It's at negative inflation. This is mainly due to the base effects. From Q3 onwards, as you see here on this particular graph, Q3 of 2025 onwards, the central bank believes that inflation will pick up. There are, of course, upside risks and some downside risks to this. Some of the upside risks can be upward pressure on global food and energy prices. It could be adverse weather, deviation from the fiscal consolidation path. These are some of the upside risks. But if you take some of the downside risks, what you see is there could be possible price reductions among essentials, or sometimes there could be diminished purchasing power of people. So these are some of the downside risks and upside risks to inflation, and also dealing with that is the monetary policy. So moving away from the central bank to the US Federal Reserve, we see the Federal Reserve also maintaining its policy rates. And as you can see here on this particular slide, according to a Bloomberg article, the reasons being given out are balancing inflation and employment stability, managing uncertainty in economic outlook, sustaining the economic growth without overheating the economy, ensuring stability in financial markets, and of course flexibility to adjust policy as needed. So moving away from the monetary policy aspect to growth, Sri Lanka has been seeing sustained growth. Q3 also there was 5.5%. Q4 projected could be somewhere around 4.5 to 5%. And also on a quarter-on-quarter basis, you see growth slowly picking up, and that is what you see here on this particular graph. On to your left-hand side, you have your annual GDP growth from 2011 onwards, and on your right-hand side, you see the quarterly GDP growth. And what you see here on this particular graph is the sectoral growth. What are the sectors contributing to this particular growth? Starting from agriculture, contributing about 3%, which is in the gray line, Q3. Services contributing about 2.6% to GDP growth, that is also in gray, that is the middle graph. And to your right hand side, what you see is the industrial contribution to GDP growth at around 10.8%. Why is it at 10.8? Because of the base effect, when you compare to 2023 Q3, the industry contracted significantly. Now, we also have to look at the outlook for growth, and a good indicator for that is the PMI index. So the PMI index for December in terms of manufacturing and services is what you see here on this particular slide. For me, PMI manufacturing, it's at 57.2, and PMI services at 71.1. The main reasons being given out is, of course, December was a festive season, and the expectations for PMI manufacturing for the next 3 months remains optimistic, which is a good sign. And same goes for PMI services. Again, December being a festive and season with tourism boost, and expectations again for business activity remains positive. So these are positive signs, building momentum. And from that, we move to the fiscal front, and that is what you see here. And on the top block, what you see is the expenditure, 2024 Jan to November compared to 2023 Jan to November, and the bottom half is the revenue aspect. Now, if you look closely at the revenue aspect, total revenue for 2024 Jan to November is shown in red, 3.6 trillion rupees, which is a significant increase compared to 2023 Jan to November, which was at 2.7 trillion. Now, if we break down the revenue authorities from customs to excise to the inland revenue, customs brought in about 1.5 trillion, rupees for the year 2024 in totality. Inland revenue brought in about 1.9 trillion, out of which 700 billion came from VAT and another about 1 trillion coming from income taxes, and the rest coming in from excise duties. Now, if you look on the top, which is the expenditure aspect, expenditure has increased very slightly from 4.7 trillion in 2023 Jan to November to about 4.8 trillion. So, on paper, revenue has grown significantly compared to the increase in expenditure being very slow. On the external front, what we see here on this particular side is merchandise exports picking up. Now, it's important to note merchandise exports is at around $12.7 billion. But for the year 2024, Sri Lanka recorded its highest exports at around a little above 16 billion, the rest coming in from the services sector. And the target for this particular year is also given by the Exports Development Board, and they have quite an ambitious target for 2030, which is at around $36 billion. And as you can see here on this slide, to your right hand side is worker remittances. You see that worker remittances are slowly picking up from the 2022 lows. And also what you see on to your left hand side is the FDI flows, and to your right hand side the tourism numbers coming in. So if you look at the left hand side, FDI inflows have been fluctuating significantly. It has been an issue for Sri Lanka. In terms of tourism, numbers don't say everything, but this is a breakdown of tourism numbers for each month for 2024 compared to 2023, and the benchmark year of 2018 from a breakdown of the tourists coming in from different countries. So that's a quick update for the month of January. Hope to see you soon. Thank you very much.